These measures should deal with the problem of liquidity, but they do not deal with the underlying problem of solvency. The thrust of that article, at least the first part, was that the Fed had a long-term auction facility set up for this coming Tuesday, $200 billion for all the primary dealers, which are not just banks, but also Metropolitan Life, Bear Stearns, other non-bank actors that they trade and clear their treasuries with on a daily basis. But Bear Stearns went belly up on a Friday. Many say that $200 billion facility to open up next Tuesday was designed specifically for Bear Stearns, but the situation was so terrible that Bear folded before that. So what we have is a solvency problem, not just a liquidity problem. The lead editorial in today's Financial Times states, Bear Stearns is a leverage machine with only $11.8 billion of capital from its shareholders, supporting a balance sheet of $395 billion, most of it bonds, and many of those backed by mortgages. So picture this, Bear Stearns had $11 billion in the kitty that it could play with, and it was controlling $395 billion worth of assets. When you become that highly leveraged, even small market moves adverse to you can bankrupt you overnight, and this is what happened to Bear Stearns. It's like those people who play the futures markets run a very high risk of losing more than their initial outlay because they put up just a tiny amount of money, and the losses just amplify across your positions. Indeed, this excessive leverage played a critical role in the 1929 crash. As you'll remember, back in the roaring 20s, people could buy stock on just 5% margin. And then when they made a lot of money, when the market was going up, untold millions were made. However, when the market crashed, those people who only put up 5 or 10% margin, their losses were far more than their net worth, and those losses just caused the crash. Another factor that was key in that crash was, of course, the 1927 real estate crash in Florida that preceded it. So to address this problem, the Glass-Steagall Act was passed in 1932 after the stock market crash, after a large public outcry. And now average traders need to buy stock on margin. They have to put up half the capital, 50% margin requirements. So you're not nearly as leveraged as before. Unfortunately, and this is the critical issue that the American press is missing, the bond markets and the derivative markets are still at 2 to 5% margin. You can trade these enormous sums of money like Carlyle did. Carlyle was 30 to 1 ratio. They only put up 3% of the money, and they controlled far more than that. Once again, Bear Stearns only put up $12 billion, its kitty, and controlled $395 billion. But when those margin calls come like in the futures markets, it ripples throughout the economy and will affect all of us. So that's one of the key points to remember in all this, which is why I want to have this series of videos and this documentary film to explain to people some of the reasons why we're going to crash. I'm sorry to say it, it's not something I can stop. The problem that we have, one of the key problems, isn't just subprime mortgages. It's mortgages, it's all types of mortgages now. For example, the Financial Times reported last week that half of all the foreclosures in the United States, or around half, are non-subprime mortgages. The Alt-1 mortgages are defaulting. The higher grades of mortgages are defaulting. It's a growing contagion. For example, it wasn't the subprime that caused Bear Stearns' downfall on Friday. Again, from the Financial Times of today, system braced for a ripple effect. Rivals said Bear's distress was evident on Thursday when the bank sold a large number of securities backed by Alt-A mortgages, loans that are less risky than subprime at distressed prices. So the problem is not just subprime mortgages. Now, I'm not the first one to foretell this coming crash, and I wish all of us luck in dealing with it. Financial Times, December 18, 2007, months ago, the wise sage John Dizard states that Goldman Sachs had placed some remarkable bets. He talks about the role of the Fed and whether or not it will be enough. There will need to be more large sale of equity in banks and dealers, most readily to the sovereign wealth funds. A PowerPoint presentation crossed my email last week with a note from a buy-side person saying, "Fell off a truck." I asked John if he'd release the actual PowerPoint to me. He did not. I would still like to obtain it. It was from Goldman Sachs for what were termed large bank basket stability notes, and I'll explain this a little bit later. This is definitely not a retail product. It's a wholesale product for well-heeled investors. To summarize, the notes, which have a 3-year term, pay 10% a year to the holder to take the other side of a Goldman bearish position. The notes are a basket of 50 international bank stocks. In this structure, the PowerPoint document says, investors earn 10% for each reference stock, as long as that stock does not decline by more than 50% during the next 3 years. So, in mid-December of last year, December 18th, the Financial Times was reporting that Goldman was approaching its well-heeled clients, some of them, with propositions saying, let's say you give us $2 or $3 million. We'll pay you 10% on that. Now, that's a great rate of money, as you know. And if you put up $3 million and you get $300,000 a year interest, you know, that's lunch money for some of these people. So Goldman said, however, you won't get your full 10% back because this is all going to, if the following scenario unfolds. 50 money center, the largest banks in the world, were betting that, because they're taking the opposite side of the position, that they will lose half